Hello, my name is Elliot Gu. I'm the editor of Personal Finance as well as the Energy Strategist. This week I want to talk a little bit about the big news of the week, which was the announcement that Exxon plans to take over XTO Energy in a $31 billion takeover deal. Now basically it's an all-stock deal, and Exxon is going to be giving out a little over 0.7 shares of its stock for every share of XTO. In addition, they're going to be assuming about $10 billion of XTO's debt. Obviously very good news for XTO shareholders. The stock was up more than 20% virtually overnight when the deal was announced. So XTO shareholders should be very happy. But the deal, I think, has implications that go well beyond a shorter term pop in XTO shares. The reason for that is that XTO is in the business primarily of producing U.S. unconventional natural gas reserves. In the third quarter, roughly 82% of their production was natural gas. They do have a little bit of exposure to the Bakken shale oil play, which is a U.S. unconventional oil play. But just to sort of give some background on what exactly unconventional gas is, in a typical gas well, obviously the gas is not located underground in some sort of a giant cavern. It's actually trapped in the pores within a reservoir rock. In traditional wells, your typical reservoir rock might be sandstone. When you drill a well into that sandstone, the gas naturally flows through that rock and into the well because it's under geologic pressure. In a shale reservoir, such as the Barnett Shale of Texas, the Haynesville Shale of Louisiana, or the Marcellus Shale in Appalachia, the reservoir rock is actually not particularly permeable, meaning that it's difficult for the natural gas to flow through the rock into the well, even though it can be under quite a bit of geologic pressure. Producers really use two basic techniques to make this all work out. People have known gas has been in a lot of these shale plays for decades, but thought it was uneconomic to produce. Now we're finding that through a combination of horizontal drilling, which is simply drilling down and sideways through the layer of productive rock, and what's known as fracturing. Fracturing involves pumping a liquid into the ground under extremely high pressure and actually physically cracking the rock. This creates cracks and crevices through which the gas can pass into the well. So these two key techniques, fracturing and horizontal drilling, have turned shale plays and other unconventional gas plays like the Barnett, like the Haynesville, from sort of uneconomic plays into the most prolific and fastest growing gas producing fields in the United States and really in the world. What this Exxon deal shows us is a number of things. One, these unconventional fields, if there was any doubt, are a world-class play. A company the size of Exxon, the world's largest energy concern, does not get involved in a field like this without reason. Obviously, they see a lot of growth potential in production coming from these fields. They do have some experience both with unconventional gas as well as with XTO. They actually partnered with XTO on a field in Colorado. So Exxon knows exactly what it's doing. And it's making a big bet on the future world-class potential of these U.S. unconventional natural gas plays. The other thing is I do think that it indicates that Exxon sees long-term upside potential in U.S. gas prices and U.S. gas demand. Right now, obviously, natural gas prices are relatively depressed, at least compared to where they were in, say, the summer of 2008, though they have obviously bounced off their lows. Probably we need to see natural gas prices move back reliably in that $6 to $7 a million BTU area for natural gas production from a lot of these shale plays to generate an economic return. So I do think this deal probably indicates that Exxon sees natural gas prices moving back up into that range longer term. And so I think that they took advantage of currently depressed prices to go ahead and purchase XTO at what would be a slightly more favorable valuation. What does it mean for the industry at large? Well, Exxon often acts as a catalyst for the rest of the industry. Back in 1999, Exxon bought Mobil Corporation in an even larger deal. It took about a year for that deal to get approved, but actually formed sort of an accelerant for the whole industry, kind of pushed Chevron to take over Texaco, pushed Conoco and Phillips to merge. Exxon often acts as sort of the first mover in setting off a wave of merger and acquisitions activity. When you couple that as sort of accelerant with the fact that credit markets are in a lot better shape than they were a year ago, and valuations of a lot of natural gas producers are way down from where they were a year and a half ago. I think you're going to see 2010 shape up to be a real merger mania, a real merger boom. A couple areas to look. Obviously, companies like XTO, heavily committed and involved to unconventional natural gas production, would be the first place to look. I would tend to focus first on companies involved in the hottest shale plays in the United States. The Haynesville Shale is one to watch very, very carefully. Haynesville Shale, located in Louisiana, parts of East Texas, is one of the most economic shale plays in the United States in the terms of the break-even cost. The cost of natural gas that you have to have in order to make an economic play is lower than for most other shales in the U.S. Another play to watch, the Marcellus Shale, located in places like Pennsylvania, Virginia, and West Virginia, located along Appalachia basically. This is another play, lots of upside potential, potentially a gigantic play, also relatively low cost. Another sort of emerging play to keep an eye on, the Eagle Ford Shale, located in South Texas. Kind of early stages for this play. Companies started talking about their acreage there just over the last couple of quarters, but it does appear to be a relatively low-cost play. Look for companies that have heavy exposure in terms of producing out of those key shale plays. But I also think it's important that we look beyond just the natural gas industry towards other sectors of the energy market that may see merger and acquisition activity. Keep in mind this was not the first acquisition of the year, and it actually wasn't the first acquisition within the energy strategist portfolios. Earlier this year, Yangzhou Coal, which is a Chinese coal mining firm, agreed to purchase Felix Resources, which is an Australian coal mining company. Obviously, China has very fast rising demand for coal, both thermal coal used in power plants and metallurgical coal used to make steel. India, also a huge and really I think underappreciated importer of coal. They could need as much as 200 million tons of coal imports over the next 5 years or so, likely to be the fastest growing importer of coal in the world over coming years. The key country to watch, Australia. There's going to be a lot of takeover activity in the Australian coal sector because they are the world's largest exporter of both thermal and metallurgical coal. Smaller Australian coal producers, they're all targets. Another area to watch very, very closely, services. Earlier this year, we saw Baker Hughes make an acquisition bid for BJ Services. BJ Services, a company heavily involved in the fracturing industry, basically in the North American unconventional natural gas industry. Baker, one of the smaller services firms. You combine the two, you have a company with sort of more capabilities. Better capabilities in the service area allows you to bid on a wider variety of contracts. That's because a lot of producers want the same service company to handle all aspects of a particular project. Therefore, by consolidating like that, you can often enhance your attractiveness in terms of being hired to do work. Baker, BJ's getting together. Look at some of the smaller services companies out there. Companies like Weatherford, companies like Smiths International. These smaller services companies really don't have the scale of the big guys like the Schlumbergers and Halliburtons of the world. And so they may actually look to merge or acquire a smaller player to try to beef up their capabilities, make themselves better able to bid, especially on international contracts, places like South America and Iraq. So those are three areas to look at. Number one, use that ExxonMobil XTO deal as a blueprint for looking for future deals. In other words, look at U.S.-focused natural gas producers with heavy acreage and experience drilling in U.S. unconventional gas plays. Look at Australian coal industry. Heavy demand from China, heavy demand from India, and we already have a Chinese company taking over an Australian coal mining firm. And last but not least, take a very close look at the oil services industry. There are too many companies involved in this business. Some of them just don't have the scale to compete with the likes of Schlumberger and Halliburton. They're going to need to do deals to make sure they have the capabilities that are in demand internationally. So those are three markets to look at for a 2010 merger mania. Thank you very much.